Hello everyone, in today's video I'm gonna show you how to implement a cover call strategy. So what is this? Well, you basically buy a stock and sell a call. It seems quite simple, however there are many things to be considered first. Firstly, I've drawn this payoff diagram. Since I'm selling a call, I have limited gains. So for example, imagine I buy a stock for 30 reais and sell a call with exercise price of 32 for 1 real. If the stock price moves more than 32, I'm gonna have to sell it for 32. So the maximum gain I can get from this strategy are the 2 reais plus the premium of 1. So why do people do this strategy? Well, the main thing is the yield enhancement because the call writer gets a premium no matter how the market moves. So if I sold it all the money and the call is exercised, I still get a gain. So this can be seen as an extra stream of income. This can also be a way to reduce positions. So imagine a portfolio with 1,000 stocks and they want to reduce this position. So instead of selling the stocks and potentially triggering a high capital gain, they can just sell calls. And even though they can still get capital gain, it can be less and can also be a way to avoid a high cash drag. And lastly, target pricing, which is considered an hybrid strategy. So imagine that I'm an investor and buy a stock. I bought a stock for 30 reais, but I have my fundamentals, and I think that the stock is worth 35. So I just sell a call with an exercise price of 35. So I won't mind if the call will be exercised because I sold it for the price that is worthy. So when do I enter this strategy? Why do I enter this strategy? Which time of horizon should I choose? Well, firstly, we should analyze the option Greeks. Starting with delta. So delta is a measure of how much an option price is expected to change when the underlying stock price changes. So call options they have positive delta, but since I'm selling those call options, I have a negative delta. Those calls can be in the money when the delta is higher than zero point 0.5, at the money when it's zero point 0.5, and out the money when it's lower than zero point 0.5. All the money calls offer the lowest premium, but they have the lowest probability of the option being exercised because they just have the time value. They don't have intrinsic value, which is different from in the money calls. Because here you have intrinsic value and time value, so there's a higher premium, but a higher chance of the call being exercised. We have the delta, and also we have gamma. So I need to show in a plot. It's easier to explain. So that's a traditional call gamma versus delta. So when the stock price moves up, delta gets higher. However, we are selling those calls, so it's the opposite direction. So as you can see, uh, delta goes down as the stock price increases, and it starts going down when the option starts to get at the money, and it's in this period where the gamma is more negative, like here. So that's the time where your exposition is gonna be exponentially reduced. So that's the importance of if the investor is very worried about reducing the exposition in a stock, like don't want to reduce the exposition, he should buy back the call when it starts to get at the money because that's the period where the gamma is more negative. So delta is gonna start plummeting at the money until it gets to zero when it gets deep in the money. So yeah, that's the importance of analyzing gamma if I don't want to reduce my exposition. There's another way called theta, which is like how it measures the extrinsic value of an option when the time passes. So when you buy an option, time is your enemy. However, I'm selling an option, so time is our friend. And what happens here is that like this is called time decay, and when it starts to get next to the expiration date, 30 days, this is the period where the stock, where the call or the option starts to decline faster. So if I'm selling a call, I want to sell in this period because that's the period where it's going to decline more. So if I want to buy back my call, uh, well, I imagine it's like 15 days. I'm gonna buy. I can. There's a probability of me buying for a lower price because of the time decay, and especially and it's even better if I'm buying when the volatility is lower. So that's what we're gonna talk now, the implied volatility. So this is the volatility that the market is specifying is different from the realized volatility. So the higher the IV, the higher the option price. So I want to sell the call when the IV is high. And well, how do I get this IV, the implied volatility? Well, you have a lot of methods. You have the binomial method, you have the Black-Scholes, and a lot of other ones that is beyond my scope. Black-Scholes is like the most common for European options, and what is specifying, like the price of an option, is the probability of it expiring in the money minus the probability of not expiring in the money. And well, to get the implied volatility with that, well, you have, for example, well, imagine that the call price is like $1, and I have to get the value of the volatility. It's like an inverse optimization, inverse algebra thing. Even though I don't think you use algebra methods to solve this. It's like another level of mathematics that again is beyond my scope. So because of that, but there are a lot of libraries in Python, RStudio that calculate this for you. So let's start with our implementation. So based on all that we already seen, getting a 1 month time horizon can be a very nice strategy because the time decaying will be higher. The option will, will decline price faster. You have a more negative theta, but I'm starting the option, so I get positive theta. So and I also want to sell it when the IV is higher than average. And also I've chosen to do all the money calls. 0.3 might be a good choice. If the investor is very worried, like, oh no, I don't, I want a very low probability of, of this call being exercised, like you can reduce the delta to 0.2, for example, or you want a higher premium, you can get higher 0.35, 0.4. It's up, it's all up to the investor. And I've chosen the classic Petrobras. Petrobras is one of the largest Brazilian public companies, and it's seen as a good example of a cover core strategy because it's a company that has a very high dividend yield, and it's like not the kind of stock that people are very worried about price appreciation. It has a high liquidity, lower option spreads. It's easier to roll in position, and they also have a very high IV because it's a stock exposed to Brazil risk, and there's also a lot of government influence, government control. So it's a stock that provides a lot of opportunities to doing this strategy. So this is why it has been chosen. Well, I'm not using the ADR of Petrobras. Instead, I'm selling the call straight from the Brazilian Stock Exchange. And why I'm doing that? Well, basically, the Brazilian Stock Exchange provides all the data, all the calls, and puts data historically. Because I'm not using any data provider, so it can be an easy option. However, the Brazilian Stock Exchange doesn't have an integrated API. It's like very kind of old system, kind of dinosaur thing. Well, fortunately, there's this legend called Wilson Freitas. He's a Brazilian economist, and he developed an R library called RB3. And with that, he turned, very easy to extract data from the Brazilian Stock Exchange because manually is impossible. And also in his library, he developed a method to dynamically extract the data and calculate the price volatility using the Black-Scholes model. So that's his website. He publishes a lot about the Brazilian yield curve, projections, and uh, to get the data, I used his script that is published here. And here he has all the there's yeah, basically all the script here. What he's basically doing, he's extracting all the data from the Brazilian Stock Exchange, and with that he's getting the implied volatility and the delta from each option. There he has done a lot of very interesting observations here. He did like a time series with call inputs and interesting an interesting observation is that IV can be mean reverting. So maybe you sell with a high IV and wait for being mean reverted to buy it again when the IV is lower, when you sell it when it's above mean, for example. Yeah, he also did on other interesting observations, like the difference of the implied volatility and the realized. So yeah, there's a lot of nice things here. So getting back to our model, I I use his script to get the data to calculate the IV, and from that we get the data frame. It's, in our studio in R is not called data frame, right? Yeah, data frame is on Python. So yeah, we get all this data here. For example, here from the data, I extracted all the money options with delta next to 0.3, and I get since the start of the year, and all from 1 month. So for example, here is a call like from 2 of January, it expires 31 of January, or this one here, 3 of February, they expire on 28th of February. I've done the calls and puts. There's all the information, how the underlying closed, the rate, this day, the implied volatility, and the delta, which are the most important variables. So how this was done? Well, after getting the data, get like close to 1 month, 1 month of expiration. So it's the difference between the day and the closest expirations of 21 days, and then filter of to get deltas next to 0.3. Like it's not gonna be exactly 0.3, so this is why I use this script to get next to it. And then I plotted did a ggplot here to see how was the implied volatility of calls and puts with time in a, in a in a time series. So what can be observed here is that in the last months the IV has been higher than the start of the year. So I got like a 6 months time horizon, and I know it's not the ideal. The ideal is to get at least 1 year. But whatever, you can see there's like there were some peaks. Like this was a very good time to do a cover call because the IV just like exploding. Like here was also a good day. Maybe here too. So in the last day, like today, 7th of June, but when I did all this was during the 5th of June. Like during this period, the IV for puts were quite high, especially in comparison with calls. So maybe here was a good time to do a risk reversal, which is like selling a put and buying a call, all the money. Also here, maybe. So it's always interesting to observe the dynamics of the IV. So there are a lot of quantitative methods to see what is the ideal period, ideal IV, to sell the call. You can do, I mean average, or you can also do a fundamental analysis. For example, you believe the realized volatility will be lower than the market is specifying now of the implied volatility. So you just sell the call based on that because you have conviction that volatility, the IV will get lower eventually. So yeah, in resume, you should you should start your position like get like a 1 month time horizon, and once a month sell call to get like an extra yield, and position yourself when you have those IV peaks. And since the option is 1 month time horizon, and you are afraid of the stock getting higher to the point of the option getting at the money, you can just like buy back the call, and since you sold it with a high IV, there's a probability that the IV will be lower, and you also had some time decay. That's the importance of it. So let's do a trading implementation. So for example, during the 3 of June, which was the last day, uh, though there are those calls and puts, and yeah, well, since the volatility was kind of high, let's do a trade implementation with this contract here. So this contract was priced as 0.34, has a delta next to 0.3. The stock price was next to 30.18, and the strike price of 31.68. Well, that's the payoff diagram. Basically the same from before. So imagine the investor that has like 6,600 Petrobras stocks, which is like 200,000 divided by 6,600. Yeah, so I get the amount I have divided by the, sorry, what was again? Okay, so I get my position. I have 200,000 in Petrobras, and I divide it by the amount of stocks. So I'm gonna sell 6,600 Petrobras calls and get a premium 2,244. So I get a yield of 1.1%. So the delta before the strategy was 6,600 because each stock I have is equal to one delta. So then each call counts as a negative 0.285 delta. So 6,600 times 0.285. So in the end, I reduced my delta to 4,719. So for each $1 stock price movement, stock will move up by 4,719 my portfolio instead of 6,600. So in fact, I reduced my position. What happens with Petrobras is that like actually with the Brazilian options, stock options, you have American and European options. So, but in this example, this is an American option. We use the Black-Scholes method to calculate the IV. It's not the ideal, but but we are doing one assumption here. So since it's an American option, it can be exercised at any day. So imagine suddenly there's like a very good news and the stock price moves up 5%. You don't even notice, and the call is exercised, and you basically sold all your position you had, because the call get like at the money, and then in the money, and basically have now zero delta. And there is also another implication when this kind of thing happens is that you're gonna trigger capital gains because imagine you're like for you bought it for 25 reais and the call was exercised and you sold for 31.68 plus the premium of 0.34. So you just triggered a huge capital gain because you just exercised the option. Um, and was everything so fast and you yeah you just have zero suddenly. So that's the importance to keep checking. Or there are some brokerage that they have some functions to avoid this this kind of event. And this is when the theta decay is beneficial because it's getting at the money. Imagine in 15, 20 days I can just buy back for a low price and avoid this kind of situation. And let's see how price moved. Right now is 7th of June, so 4 days have been passed. Uh, let's get the contract. Yeah, so right now the price is less than half, 0.15. So in fact, if I want to leave my position now, buy back my calls, I still got, 60% of my premium. So imagine, I think in the next, 15, 20 days, Petrobras will just like go up for some reason, and okay, I want to just buy back my just buy back my call and not risk it. I still got 60% of my premiums because it was like 34 before. So this can be a way to think. And this price reduction was all of extrinsic time value. I don't know what is the IV of this day, but yeah, probably the IV is might be lower plus the negative theta that reduced it. So yeah, there are like some limitations. Like I said before, like in shows, maybe not the best model to specify some of the specific American options in the Brazilian Stock Exchange. We talked a lot about theta, but we got the light theta. We don't got the stronger one, like because the time decay is even higher. It's like even more stronger when we're considering more add the money options. So like for example, we want to increase our delta to 0.35. The theta will be stronger. The the time decay effect will be higher. There's the thing about also about suitability, like investors, people that are doing this strategy should know very well what's happening with the payoff structure and all the risks like it can have of triggering capital gains and suddenly reducing their position because the call was exercised. So well, as I said before, there's no loss if the call is exercised if I sold it all the money. This can be like uh, kind of a light strategy. For example, in comparison with risk reversal, for example, I can just like have a huge loss because I sold a put and well, imagine I sold a put with exercise price of 34 and they put this exercise for 30. I just lost like $4 per stock. Imagine if I had like you know 100,000 of this stock, I just lost $400,000. So the good thing of cover calls is like you don't have this kind of negative payoff unless maybe you're doing some in the money strategies, but it's not the case. So they can be an effective way to generate extra yield when the investor is not concerned about the stock being called away early. So yeah, that's basically it. I hope understood the model, and try to get some money with it.